Joining us right now for insights on today's data and this week's inflation reports is Nathan Sheets. He is global chief economist at Citi, and we'll talk about these numbers we just got in a moment, Nathan. But I think one of the most interesting things that jumps out to me is that you are still expecting that the Fed is going to cut 125 basis points this year out of rates, and that's counter to what a lot of other people are expecting at this point. I'm looking at Citi that now expects 0 cuts coming from the Fed. Why don't you lay out how and why you see that happening?
Yeah, thanks, Becky. I think the key here is that we are expecting a soft landing in the U.S. economy. The consumer, we see a savings rate of around 4% on the low side. And we think that the consumer is ultimately going to adjust. And that as the consumer adjusts, that's going to weaken demand in the economy, and we're going to see some softening. Now, clearly, I don't think we saw it in these numbers today. I think this is still a solid labor market, and retail sales continues to look solid. But, it strikes us as broadly unsustainable. The consumer's going to retrench. The softer housing market, weaker manufacturing sector will all be in play. And as that happens, the Fed is going to move to cut more. But given today's data, we still see that's a ways down the road, more mid-year than where we are today.
That's what I was going to say. May, before you anticipate seeing any additional cuts coming from the Fed, because the data just doesn't support it right now. Inflation's running hotter, and the economy's doing very well. What makes you think that is going to happen? What makes you think that the economy erodes from here? What are the signs that you're seeing that maybe others aren't?
Well, I think, and I alluded to this, I think one key sector we're watching very closely is the housing market. And with 10-year Treasury yields in the neighborhood of where they are at the moment, the implied mortgage rates are just choking off activity in the mortgage market and in housing, and that's a big part of the economy. Secondly, we think the consumers are stretched, particularly the bottom half of the income distribution. We're seeing ongoing stresses. Also, some stresses amongst some of the smaller firms in the economy.
And then about the Russell 2000?
Yes, exactly, exactly, and even smaller than that. Yeah. Maybe think of firms with 100 employees or less, which are very dependent on the banks. And the banks just haven't been lending, and we don't think are likely to. And then finally, we've seen longstanding weakness in the manufacturing sector, largely reflecting strength in the dollar. And with next week's inauguration, we're not expecting any weakening of the dollar anytime soon. So you put that together, I think there is a litany of downside risks that we need to worry about.
The Philly Fed, I realize that you've already said that today's numbers don't really play into this. The Philly Fed index showed 44.3. Rick said that was the best number since April of 21 when it comes to that manufacturing gauge. You think that manufacturing is not going to do well in the United States, even if the new administration comes in and does things like give people much lower tax rates if they are manufacturing in the United States?
Well, there certainly are economic incentives that can be put in place that would be beneficial and would help support manufacturing. Kind of my sense is that's unlikely to happen sufficiently quickly to forestall some of these adverse dynamics that we're expecting to occur. But certainly, if Trump finds ways to rapidly stimulate the lagging manufacturing sector, that's going to be constructive and could lead to other outcomes. Now, by the same token, if Trump is being aggressive, we're also likely going to need to talk about tariffs. And tariffs have a multiplicity of effects. But one of those is it makes imported intermediate imports of which the manufacturing is very reliant, it makes them more costly and can be challenging for the manufacturing sector.
Hey, Nathan, I realize you're the chief economist, not a market strategist, but does Citi's market strategists take your view of the economy into account when they're trying to figure out where they think stocks are headed this year? Because if the economy really does weaken, that sounds like a much worse scenario than just the Fed deciding not to cut rates anymore, which seems to be the knee-jerk reaction that drives stocks down right now.
Absolutely, they take it into account, but let's say it's a dynamic process. They don't take the economic forecast necessarily chapter and verse the way that we articulate it. But I think if you look carefully at the analyses of our Citi equity strategists, that they're very much thinking about, well, suppose the economy continues to remain strong, what does that look like? But then similarly, if the economy softens, and in that instance, S&Ps in the mid-5,000s are certainly possible.